So how do you calculate the alpha of a trend follower? Well, until we came up with trend following alt beta, there was no way you can do that. Like I said, regardless of whether you want to be a quant manager or a discretionary manager, you have to have a strategy. All I can say for aspiring hedge fund managers is that a CTA is basically a commodity trading advisor. In order to, and this is just basically technical classification. So if you trade futures, now everybody's regulated. If you trade securities, you are regulated by the SEC. In our case, we only trade futures. So we're regulated by the CFTC through its regulator, which is the NFA. I forgot for a second, the National Futures Associations. So it's just basically a classification, and you have to pass certain tests and fulfill certain requirements. We get audited regularly by the NFA, and we go through the whole process. The NFA is amazing at how easy they make it for you to help you navigate through that process. If you decide to trade futures, first thing you should do is go on the NFA website and see what you need to register. You need to take Series 3, but I'm not a lawyer or a compliance officer, and I don't like to play one on TV. But all I can say for aspiring hedge fund managers is that just by calling the NFA 800 number, they are extremely helpful and knowledgeable and will guide you through the whole process of what it takes to be registered as a CTA. Now, let me just say it's a very simple process. You can register in a couple of days. The only part that is more time consuming is passing your Series 3 exam. And that's also fairly simple. I mean, you study for it, you take it online. Then you have to take an ethics module, and then you have to go to regularly update your ethics requirement. Essentially, every strategy that you trade or every group that you trade is called a pool. So any CTA can trade multiple pools. If you trade multiple pools, you need to also have CPO classification. But again, it's just a matter of registering. Typically, every CTA registers as a CTA CPO. You do it through the same process just to get, you have to renew it annually. You can be guaranteed to be audited every couple of years. I would advise any aspiring fund manager to learn exactly what happens in the audit and make sure that from day one, you're keeping all the records that you need to be keeping in order to, typically in an audit, the NFA comes to your office, they commandeer your conference room for about a week, and then they give you a list of everything that they need to check. You have to make sure your marketing material is compliant. You have to make sure you're keeping a record of your trades. You have to make sure you have, for example, if you're trading multiple accounts under the same trade, how you allocate trade between different accounts, things like that are fairly technical. I've been fortunate enough throughout my career to have very efficient compliance officers, CFOs, and COOs. Essentially, the way we conduct our business is in a way where we can get audited tomorrow. So we always have everything ready. So anytime an audit happens, it's more of a question of how long we're going to lose our conference room than anything else. How does alt beta differ from traditional investments? And I don't think it does, especially when you compare apples to apples. So if I'm looking at an alt beta trend follower versus a 2 and 20 trend follower, I don't think there is a difference. Actually, there is a difference, is that I think the alt beta would do better over time. And again, here we go back to the notion of equity risk premium. We are all very comfortable ascribing risk premium to being long equities. We know that we get a better equity risk premium at times if we go in the Russell with the small cap, have a higher risk premium than large caps. Sometimes tech stocks have a higher risk premium than your typical S&P 500. It's because for 100 years, we've understood what equity risk premium is. If you look at the S&P 500 over the last 100 years, it made probably around 14% average annual return with about 14, 15% volatility. So we know that in the sense that there is a free lunch out there, the being long equity free lunch is that you're going to accept a certain volatility above being in treasuries. And in return for that volatility, you're going to get 7, 8, 9% equity risk premium that's going to be over treasuries. When you expand that concept of equity risk premium to other sector risk premia and trading style risk premia, investors start sort of short-circuiting a little bit. So you have to expand your brain to say, okay, well, why do equity have risk premia? Well, technology stocks have risk premia because of all the innovation that happens. And that's, in this case, let's look at risk premia of technology over S&P 500. Lower cap, smaller cap risk premia can happen, for other reasons. Let's look at international equities. Well, international equities have their own risk premia over the S&P 500. Distressed securities have risk premia over, the S&P 500. So the concept of risk premium that you are very comfortable with when you look at equities, in the same way that it exists in equities, exists in other asset classes as well. There is no reason you only have risk premium in equities but nothing else. Now, the next way you want to broaden your understanding is that, okay, so there is an asset class risk premium, but there is also a trading style risk premium. So by going long-short equity, you are extracting a different risk premium than always being long equities. By doing trend following, which is also another trading style, at the end of the day, all you're getting is risk premium, because these are things that are, and how do you define risk premium? It's something that is always available over time, over a benchmark that is quantifiable, measurable, all that kind of stuff. Now, when hedge funds started, so if you look at the hedge fund giants of the past, so George Soros, Julian Robertson, all the great guys, in a way, they understood this risk premium concept. Their biggest genius was in terms of asset allocation. They had large pools of assets, and they knew when to be in long-short equity or equity, when to be in trend following, when to be in this. And they moved all their assets under one umbrella, under one 2 and 20 hedge fund, into all these different risk premium. When the hedge fund industry started growing, and then suddenly you had each risk premium being offered at 2 and 20, suddenly a lot of that alpha that was available by moving from one risk premium to the other disappeared because of the high. So you had each individual sub-strategy charging 2 and 20, and then the allocation to it charging 2 and 20. So the risk premium is still there, but all the fees ended up eating that up. So if you go directly to an alt beta model that eliminates that risk-free structure, you are getting that risk premium the way you're supposed to get it. The biggest challenge out there for investors is finding true alpha. So in the case of US large cap stocks, it's very easy to calculate alpha. You can Google the formula of alpha. It's very easy. You have to look at return over a certain benchmark adjusted for volatility. Now, if you're looking at a hedge fund manager or a mutual fund manager trading large cap US stocks, you look at the return of that manager, you look at the S&P 500, and then you see if that manager has alpha or not by applying the formula. But what if you're looking at a manager that's doing trend following? So how do you calculate the alpha of a trend follower? Well, until we came up with trend following alt beta, there was no way you can do that. But after we created the alt beta product, trend following product, now if you want to measure the alpha of a trend follower, in the same way that when you were looking at the equity manager, you compared it to the S&P, now you can look at a trend follower and compare it to our alt beta trend follower. If it constantly or persistently delivers returns above our alt beta trend follower, then that manager has trend following alpha. And you know what? They should be able to charge not 2 and 20 for it, they should charge 4 and 40 for it. But if that manager consistently underperforms our alt beta, then that manager is giving you negative alpha and you should fire them. mean, look, for what we do, like I said, since every model that we have, we can explain in plain English in 5 minutes or less, we're probably one of the most transparent quant firms out there. If you want to be a quant manager, you have to, like I said, first have the necessary quant skills. But also, let's say you want to be a quant equity manager. You should learn about how to invest equities, how to look at earnings, how to look at price earning ratios, how to look at, I'll give you a simple example. For my own money, I was interviewing a long short equity manager, discretionary long short equity manager. And he's walking me through his investment process. And he's like, look, so we start with the universe of the S&P 500. And in this first screen, we're going to screen to look at only stocks that have this PE ratio, let's say, or this condition. So now we went from 500 down to about 250. Then we move to this other screen where we have this additional condition that they have to satisfy for us to look at them. And then the 250 goes down to 150. And then we go to the third screen, and again, another condition, and they go down to 50. And the fifth screen takes it down to 25, and out of those 25, the sixth screen will give you 5 stocks to invest in. As he's explaining his process to me, obviously it made perfect sense to me, and I was looking at the things that he looked at. But in my mind, I was thinking, well, this is really what we do, right? He doesn't know it, but he has a very quantitative way of investing, because in a way, that process that he walked me through screen by screen, what his analysts do, I can program it and put it in an algorithm and have the computer sort of recycle through all these and do it like not just on US stocks, at every stock market around the world, and keep, generating these things. So, like I said, regardless of whether you want to be a quant manager or a discretionary manager, you have to have a strategy. And most coherent strategies you're able to put into an algorithm. You don't need to put them into an algorithm, if you don't have those skills, then you can just be, a discretionary portfolio manager. But if you do have those quantitative skills, it's helpful to be able to program them, backtest them, see how they would have done, change different scenarios, and see how they do in risk-on period, in risk-off. It gives you so much more flexibility of analyzing your strategy once you're able to program it and then backtest it and do these things to it. The lower fee alternative beta makes sense for the following reasons. We're all very comfortable with the concept of equity risk premium, for example. So, we all know that if you buy an equity mutual fund, it has a higher risk than a typical bond fund, but it has what we call equity risk premium, which is the return over the risk-free rate that you get from buying equities. Now, the idea that we pioneered is that in the same way there is an equity risk premium, there is also convertible bond risk premium. There is emerging market risk premium. There is, so you have different asset class risk premium, but you also have different trading style risk premium. So you have trend following risk premium. You have long short equity risk premium. So in the same sense that, look, if you look at equity mutual funds, 2/3 of the high fee funds underperform your typical S&P index fund. The reason 2/3 of them underperform is because of the fee structure in the mutual funds. There is a much higher percentage of hedge funds that underperform their alternative beta equivalent, because the fees in hedge fund, which is the biggest driver for negative alpha in the mutual fund world, is so much higher in the hedge fund world. What we really did, we said, look, it's not skill that these hedge funds are bringing you that they're charging you 2 and 20 on to a large extent. I mean, of course, I don't want to generalize. There are some amazing hedge fund managers that have been so consistent generating alpha over a long period of time, and those deserve to pay not 2 and 20, 4 and 40. However, the majority of the hedge fund world is the same as the majority of the mutual fund world. They're offering you risk premium and charging you a higher fee for it, which makes their proposition negative alpha. So think of it in the same way that the majority of mutual funds underperform the S&P index fund. The majority of hedge funds underperform their equivalent of the S&P 500, which is their alt beta component, essentially.